All right, let's jump into this market analysis. Some pretty interesting stuff here. Looks like we've got some stock picks to dig into and some potential investment strategies. Should be helpful for anyone looking to make some, smart moves this year.
Yeah, looks like a good mix of companies. Some are in recovery mode, others are riding high on growth, and some are even aiming to like totally disrupt entire industries. Should be fun.
Definitely a lot to unpack here. Well, first up is Wynn Resorts. They just had, a solid earnings report, announced a dividend too, $0.25 per share. Payable, I think, on March 5th. Not bad,
Not
right?
bad at all.
But what really caught my eye was this argument about Wynn being like a strong buy under $100. What do you think?
Yeah, it's fascinating. The analysis points to their real estate, that prime location on the Las Vegas Strip. It's valued at, get this, somewhere between $1 and $2 billion.
Wow.
Plus, they've got that strategically located golf course. They're calling all of this long-term optionality, which is interesting.
Okay, yeah. Break that down for me a little. Long-term optionality, what does that actually, mean for investors?
Sure. Well, it basically means Wynn has flexibility. They could like sell off a portion of that land, make a massive profit, or partner with a developer, build something new,
Oh, I see.
or even develop it themselves, add even more to their resort empire. It's like having this valuable ace up their sleeve.
So it's not just about, betting on their casinos, but also on their potential to make some big moves down the line with all that real estate.
Exactly.
And they're expanding beyond the US too, right? The analysis mentioned something about that.
Yeah, developments in the Middle East set to launch in 2027, and they're moving into Thailand as well.
So global expansion adds another layer of diversification.
Exactly. Always a good thing for investors.
Makes sense. So overall, it sounds like Wynn is a potential play for someone who's, looking for a recovery story in gaming and luxury hospitality.
I think that's a good way to put it. Not without risk, of course, but the potential upside is definitely there.
All right, next on the list, we've got Meta Platforms. Now, this one has seen over 20 consecutive gains in the market. I mean, you'd think it'd be overpriced by now, but the analysis is saying it's still undervalued. How does that work?
Well, the key here is understanding how to interpret, valuation metrics. Meta's forward price-to-earnings ratio, their PE ratio is around 28,
Okay.
which might seem high, right?
Yeah.
But when you compare it to companies like Costco or Walmart, which have PEs in the 30s and 40s,
Oh,
it actually starts to look pretty reasonable.
so a higher PE isn't always a bad thing. It's all about context.
Exactly. A higher PE can often indicate that investors are expecting strong future earnings growth. And in Meta's case, their projected revenue growth of 17.7% year over year in 2024, that kind of supports that higher valuation. They're outpacing those more stable, slower growing companies.
They're paying a premium for growth potential. Makes sense. And there's also like buzz about dividend hikes.
Right. Yeah, Meta's generating a ton of free cash flow, gives them flexibility to, potentially increase their dividend payouts down the line. Income-focused investors will definitely be watching that.
Got it. So it's that combination of like growth prospects, potential dividend increases, and their dominant position, in digital advertising that makes them so appealing.
And don't forget about AI and the metaverse. These are areas where Meta has a real edge, competitive advantage, could pay off big time in the long run. They're really solidifying their position.
Meta as a hold then, or even an accumulate. What about taking some profits though?
That's really a personal decision. Based on your risk tolerance, your investment goals, I mean, taking some profits is never a bad idea, but the long-term upside potential for Meta is still significant.
Okay, makes sense. Let's move on to a company that has seen some truly impressive gains. SoFi Technologies, up a whopping 143% in just 6 months.
Yeah.
Is that even sustainable?
Well, the numbers tell an interesting story. SoFi reported 19% year-over-year revenue growth in the fourth quarter, hit $734 million. And what's even more interesting is their profitability is actually expanding. So there's real substance behind this surge.
So it's not all like hype and speculation. There's actual financial performance driving those gains.
Right. And they have a bold vision. SoFi wants to become an asset-light financial giant. Essentially, they're using tech to challenge traditional banks, create a new kind of financial ecosystem.
That's ambitious. So are they a buy at this point, even after, such a huge run-up?
Well, the analysis labels it as a hold, for those who believe in their long-term, like, disruptive potential.
Oh, okay.
But that's looking 10, 20 years down the line.
So it's a play for the patient investor, someone willing to, ride out those ups and downs of a company that's trying to shake things up. What about someone who is already holding SoFi? What would you recommend?
Dollar cost averaging on any pullbacks could be a good strategy.
Okay, so we've got like recovery plays, we've got growth stories, we've got potential disruptors. What else is in store for us today?
Buckle up. Next, we're looking at Palantir, a company that's experienced a 1,497% increase since 2022.
Whoa. Okay, that's an incredible rally. But it almost seems too good to be true. Can they possibly keep up this momentum?
That's the question, isn't it? Honestly, there are some valuation concerns. To justify their current price, Palantir would need to maintain annual revenue growth above 50%.
Wow.
That's a tall order. It's causing some analysts to raise their eyebrows.
Even with such phenomenal performance, there's a note of caution here. What would you say to someone who's already holding Palantir?
One strategy is to sell covered calls. It's a way to generate income from your shares while, still holding on to them. You're essentially hedging your bet in case the stock, stagnates or drops.
That's a clever way to, potentially offset some of the risk, but it does sound like Palantir is a high-stakes play.
Definitely. It's a volatile stock, and if it goes above $125, you might want to consider trimming your position aggressively. Don't let emotions cloud your judgment.
Solid advice. Okay, let's move on to something a little bit more down to earth. This analysis pits two popular restaurant chains against each other.
Oh, yeah.
Texas Roadhouse and Cheesecake Factory.
A classic battle for your plate and your portfolio.
Texas Roadhouse, had a strong run, peaked above $200 a share. But it has corrected to $171 recently. So is this a buying opportunity or is the sizzle starting to fizzle?
Well, they still have solid fundamentals. They're projecting 11% revenue growth this year. But competition is heating up. Cheesecake Factory is, emerging as a serious contender.
Ah, so that's where the versus comes in. What makes Cheesecake Factory such a strong competitor, besides the amazing cheesecake?
Well, Cheesecake Factory has two growth concepts, North Italia of Flower Child. These are designed for scalability. They have the potential to, grow more efficiently than Texas Roadhouse's Jaggers and Bubba's 33 concepts.
So it's not just about which chain is doing well now, but which one has a better, strategy for expanding in the future.
Exactly. And then when you look at valuations, Texas Roadhouse has a forward PE of 23, which is fair. But Cheesecake Factory might actually be the less risky bet. Their lower growth expectations, around 8%, could make it a less volatile stock.
So even though Texas Roadhouse is projecting higher growth, Cheesecake Factory might be the safer play.
That's what the analysis suggests, yeah. Texas Roadhouse moderate buy, around $170. But for, growth-oriented portfolios, Cheesecake Factory might be the tastier option.
Speaking of tasty options,
This analysis also mentions a tool called the 1000X Research Platform, designed to give investors an edge, with advanced metrics, earnings call transcripts, educational resources.
I've heard good things about this platform. Sounds like a valuable resource for, anyone serious about doing their research.
It is, and there's a limited time offer right now, $30 off a monthly membership or $800 off a 2-year membership.
That's a deal worth checking out. All right, so we've covered a lot of ground. Wynn Resorts, Meta Platforms, SoFi Technologies, Palantir, and even, a good old-fashioned restaurant rivalry.
And that's just the first course.
Right, we still need to talk about those broader market trends, those big economic forces at play. That's coming up in part 2 of our deep dive. Okay, we're back. In part 1, we dug into some specific stock picks. We looked at, everything from potential recovery plays to high-growth tech companies, even had a restaurant showdown. Fun stuff.
We did cover a lot of ground, but remember, individual stocks, they don't exist in a vacuum. They're constantly being influenced by those larger market trends, economic forces.
Right. It's like, trying to navigate a ship without understanding the currents and the winds.
Exactly.
So what are some of those bigger forces that, that we need to be aware of right now?
Well, one that's been on everyone's mind is inflation. We've seen some signs that, it might be cooling down. But it's still a major factor impacting interest rates, consumer spending, the whole 9 yards.
Yeah, inflation has been a real roller coaster these past few years. It makes planning and investing a lot more challenging.
Absolutely. And another factor that adds to the uncertainty is, geopolitical risk. We've got the ongoing conflict in Europe, tensions in Asia, global supply chain disruptions. All of this is, creating volatility, impacting certain industries more than others.
It's a lot to keep track of. It's like trying to solve a giant puzzle that's constantly changing. How do you even begin to make sense of it all?
Well, it's about, connecting the dots, seeing those patterns, understanding how these macro forces might play out. For example, if inflation remains, sticky, the Federal Reserve might continue to raise interest rates.
Oh, okay.
And that could slow down economic growth, impact corporate earnings.
So that could mean lower stock prices, especially for companies that are, really sensitive to interest rate changes.
Exactly. On the other hand, if inflation cools down faster than expected, we might see a much more positive market reaction. Investors, might become more optimistic about about future growth.
Okay, so inflation's a big one. Geopolitical risks are simmering. What else should we, have on our radar? Anything a bit more optimistic?
Definitely. Despite the challenges, there are some exciting trends emerging, that could create opportunities for savvy investors. Take, for example, the continued growth of e-commerce, digital transformation.
That's a great point. The pandemic really, accelerated that whole shift to online shopping and digital services. And it doesn't look like that trend is going away anytime soon.
It's not. And companies that can adapt and innovate in the digital space, those are the ones that are likely to thrive. While those who are stuck in the old ways, they might struggle to keep up. Think about how companies like Amazon, Shopify, even payment processors like PayPal, they're benefiting from this whole shift.
It's fascinating how, like, a single trend can create winners and losers, across so many different industries.
And then there's the whole world of, artificial intelligence, machine learning.
Oh, yeah.
This is like a game changer. It's already impacting industries from healthcare to finance, and its influence is only going to grow.
AI seems to be, like, popping up everywhere. But what does that actually mean for investors? How do we identify, the companies that are using AI in a meaningful way?
You've got to look beyond the hype. Understand how AI is being integrated into a company's core operations. Is it making them more efficient? Is it helping them develop new products and services? Is it giving them that competitive edge?
So we need to be discerning, do our research, don't just chase the latest buzzwords.
Exactly. A company that's, just slapping AI powered on their marketing materials, that's not necessarily a good investment. You need to understand, like, the substance behind the claims.
Okay, so we've got inflation, we've got geopolitical risks, the rise of e-commerce, digital transformation, the growing impact of AI. It's a lot. Like trying to juggle, flaming torches while riding a unicycle.
It can feel that way sometimes, but that's why it's so important to have, a well-defined investment strategy. Diversify your portfolio. Stay focused on those long-term goals. Don't get distracted by the short-term noise.
Right. It's not about trying to time the market perfectly or, chase the latest fads. It's about making informed decisions based on that solid understanding of the fundamentals, sticking to your plan.
Well said. It's about finding that balance, being aware of the risks, the opportunities presented by these larger trends, but at the same time, staying focused on your individual investment goals.
And speaking of goals, let's shift gears and talk about how to actually apply all of this knowledge. What are some practical tips to help our listeners make those smart investment decisions? That's coming up in part 3 of our deep dive.
Okay, we've explored some pretty interesting stock picks, dug into those crucial market trends that can, make or break your portfolio. But now let's talk strategy. How can our listeners, take all this information and actually put it into action, make some smart investment decisions?
Yeah, that's the million-dollar question, isn't it? It's one thing to understand the market. It's another to, actually put that knowledge into action.
So what's the first piece of advice you'd give to someone who's, trying to navigate this whole complex assessment world?
Well, I'd say, the golden rule of investing is diversification. Don't put all your eggs in one basket.
That's classic advice, but it's so important. Why is diversification so crucial? It's all about managing risk. By spreading your investments across, different asset classes, stocks, bonds, maybe even real estate, you're essentially cushioning yourself against losses. If one investment does poorly, the others can help offset those losses.
It's like having a safety net for your portfolio. And what about diversifying within those asset classes?
That's important too. Within stocks, for example, you want to invest in, different sectors, different industries, even different geographic regions. This way, you're not overly exposed to any single company, industry, or, economic downturn.
So if one sector takes a hit, the whole portfolio isn't sunk.
Right.
Makes sense. Okay, what's next on your list?
Do your research. Don't buy into a company just because it's, trending on social media or, someone giving a hot stock tip. Take the time to really understand the business.
Research is key, but where do you even begin? It can be overwhelming to try and sift through all the information out there.
Start with the basics. Look at the company's financial statements, revenue, profits, debt levels. Read analyst reports, industry publications. Get a sense of their competitive landscape, their growth potential.
So it's about going beyond those headlines, really digging into the fundamentals.
Right. Understand what the company actually does. Who are their customers? What challenges are they facing? It's like getting to know someone before you jump into a relationship.
Due diligence. We like that analogy. Okay, we've got diversification, we've got research. What else is essential for successful investing?
Patience. Investing is a marathon, not a sprint. Don't get spooked by, by those short-term market fluctuations. Don't try to time the market perfectly.
That's easier said than done. It's hard not to, panic when you see your portfolio dipping.
I know. It's human nature. But remember, the market is cyclical. There will be ups and downs. What matters is having that long-term perspective, sticking to your investment strategy.
So it's about, tuning out the noise, focusing on the long game.
Exactly. Think about your investment goals. Are you saving for retirement, down payment on a house, your kids' education? Those goals are, years, if not decades, away. Don't let the daily market chatter derail you from your path.
Keep your eye on the prize. Okay. Beyond these, kind of core principles, what other factors should investors consider?
Think about your personal values, how you can align your investments with those values. This is where ESG investing comes in.
Oh, yeah. ESG, it's becoming increasingly important to investors. Can you explain, what that means in practice?
Sure. It's about investing in companies that are, really committed to sustainability, social responsibility, ethical corporate governance. So, for example, you might choose to invest in companies that are reducing their carbon footprint, promoting diversity and inclusion, operating with, transparency and accountability.
So it's about putting your money where your mouth is, supporting companies that are making a positive impact.
Yeah, it's about aligning your financial goals with your values, making a difference with your investments.
Okay. As we wrap up, is there any final piece of advice you'd like to share with our listeners?
I'd say remember to enjoy the journey. Investing can be challenging, but it can also be, incredibly rewarding.
It's about learning, growing, building a better future, for yourself, for your loved ones.
Absolutely. So do your research, diversify that portfolio, be patient, invest in what you believe in, and who knows, you might even surprise yourself, with how much you learn, how much you can achieve.
That's a perfect note to end on. We hope you've enjoyed this, deep dive into the market. Feel empowered to make some smart, well-informed investment decisions.
Remember, knowledge is power. And with the right tools and strategies, you can navigate the markets with confidence.
And until next time, stay curious, stay informed, and happy investing.